Most people don't fail at dividends because it's complicated. They fail because they chase the wrong path, expect speed without capital, and underestimate how long real wealth actually takes. Let's fix that. You're not trying to get rich quick. You're trying to build a machine that pays you $3,500 every single month, whether you work or not. That's a completely different game. And if you understand this early, you avoid years of wasted effort. Stay until the end, because there's one simple strategy that can cut years off this process, and almost nobody uses it. Imagine waking up and seeing cash hit your account overnight. No boss, no client, just income. That's the idea everyone is sold. But here's what they don't tell you. Dividend income is not magic. It's math. And the math is simple. Income equals capital times yield. If you want $3,500 per month, that's $42,000 per year. Now look at reality. At 3% yield, you need approximately $1.4 million. At 5% yield, you need approximately $840,000. At 10% yield, you need approximately $420,000. This is the first moment where most people quit. The numbers feel too big. But here's the shift you need to make. You are not building income overnight. You are building a system that compounds into income. Dividends are not coupons. They are ownership of real businesses generating real cash. Most people feel stuck in the beginning. They invest small amounts and see almost nothing happening. The first $100,000 is painfully slow because you are doing all the work yourself. At $5,000 invested, a 10% return gives you $500. That feels irrelevant. At $100,000, that same 10% becomes $10,000. Now it matters. At $500,000, it becomes $50,000. Now it changes your life. This is the moment where most people either stay disciplined and win or quit because it feels slow. You need to understand this clearly. The early stage is not about income, it's about accumulation. A few years ago, people mainly relied on safe dividend stocks. Today, the landscape is different. You now have three main paths. 1. Stability path. Dividend growth stocks. Low yield, 2 to 4%. Strong long-term growth, reliable income increase. This is the slowest but safest route. These are companies that survive recessions, increase dividends for decades, build wealth quietly. For example, ETFs, Schwab US, Vanguard Dividend Appreciation, SPDR S&P Dividend ETF. Stocks like Coca-Cola, Procter & Gamble, PepsiCo, Johnson & Johnson. This is your foundation. 2. Income acceleration path. REITs. Medium yield, 4 to 8%. Real estate-backed income, more sensitivity to economic cycles. REITs exist because real estate produces cash flow. Instead of owning one apartment, you own a piece of thousands. They pay higher income, often pay monthly, react to interest rates and economic cycles. For example, Realty Income, Prologis, Digital Realty Trust, American Tower, Vanguard Real Estate ETF. This is where income starts becoming noticeable earlier. 3. High income path. Covered call ETFs. High yield, 8 to 12% a plus. Designed for cash flow first, limited upside growth. This is what's exploded in popularity recently. Why? Because people want income now. These funds own stocks, sell options on them, generate extra income from premiums. For example, Global X NASDAQ 100, Russell 2000, S&P 500 Covered Call ETF, JP Morgan Equity or NASDAQ Equity Premium Income ETF. This creates higher payouts, but with trade-offs. You sacrifice some growth, some long-term upside, but you gain immediate income. Now, interest rates changed everything. When rates were near zero, people chased growth. Now, bonds and cash yields more. Investors demand income again. This pushes demand toward dividend strategies. People want income, not just growth. After multiple market cycles, people realized paper gains don't pay bills. Dividends do. This is why REITs regained attention, covered call ETFs exploded, income portfolios became mainstream, volatility increased. Markets are no longer easy up only. So investors now prefer cash flow during uncertainty, income regardless of price movement. That's why income strategies are trending. The biggest mistake beginners make, they pick one strategy. This is exactly where most people fail. They either go too safe, right arrow takes forever, go too aggressive leads to lose capital, chase yield leads to fall into traps. You don't need 50 stocks or complex strategies. You need a clean structure that does one job: grow capital to convert it into income to scale it. Step 1. Build the core. High-income portfolios don't make you rich. Growth does. Income comes later. This is exactly why long-term investors rely on broad market exposure. Index funds quietly build millions over time without needing constant decisions. What you include here: S&P 500 style index funds, dividend growth ETFs, strong companies with consistent earnings. Allocation 40 to 50% of your portfolio. This is your compounding engine. This is what gets you from $10,000 to $100,000 to $500,000. Without this, you will always feel stuck. Step 2. Layer income. Now we introduce assets that actually pay you. This is where REITs and higher yield dividend stocks come in. They exist because they collect rent and distribute most of it to investors, which naturally creates higher income streams. What you include: real estate investment trusts, high-quality dividend ETFs, cash flow-focused companies. Allocation 30 to 40% of your portfolio. It boosts your income early, shortens the timeline to visible results. This is the bridge between nothing happening and I'm actually getting paid. Step 3. Accelerate income. This is where things changed in recent years. Covered call ETFs became extremely popular because they solve one problem: they generate income immediately. These funds combine dividends and option premiums, which creates higher yields than traditional investing. It includes covered call ETFs, high-yield income funds. Allocation 10 to 20% maximum. Why not more? Because they limit upside growth. They can underperform in bull markets. They are income tools, not wealth builders. Used correctly, they speed things up. Used incorrectly, they trap you. Imagine you build your portfolio over time to $500,000 total. Now apply realistic yields. Growth portion, 2 to 3%, leads to approximately $6,000 to $7,500 per year. Income layer 5 to 7%, approximately $7,500 to $14,000 per year. High yield portion, 8 to 12%, yields approximately $8,000 to $12,000 per year. Total, approximately $22,000 to $33,000 per year. You're not at $3,500 per month yet, but now it's real. Now scale that $700,000 to $900,000 portfolio leads to you reach the target. Now let's simplify everything into action. 1. Start investing immediately. Waiting is the biggest mistake. You don't invest because you have money. You invest to create it. 2. Focus on contributions first. Your first phase is not returns, it's how much you put in. 3. Reinvest everything. DRIP. Every dividend buys more shares. More shares leads to more dividends, leads to more shares. This snowball effect is everything. 4. Increase income over time. Your income growth matters more than market timing. 5. Avoid lifestyle inflation. Most people stay broke because they increase spending instead of investing. This is exactly how DRIP works. Reinvesting dividends creates exponential growth over time. What is actually performing well today? 1. Dividend growth plus tech hybrid. Companies that grow and pay dividends, tech is slowly becoming dividend-friendly. This is a major shift compared to the past. 2. REIT recovery opportunities. After rate hikes, many REITs are discounted. Long-term income potential is strong, but timing matters here. 3. Covered call ETFs boom. Massive popularity, high yields attract new investors, but many people misunderstand the risks. No one knows the future, but patterns repeat. Based on cycles, likely winners, broad index funds always, dividend growth companies, undervalued real estate assets, situational winners, income ETFs during sideways markets, value stocks during high-rate environments. The smart way to think about it. Early stage arrow focus on growth, middle stage to balance, late stage arrow maximize income. Let's be honest about the timeline. There are only 3 ways to reach this faster. 1. Increase income aggressively. This is the biggest lever. Side business, skills, career moves. This matters more than picking stocks. 2. Invest consistently, non-negotiable. Even $10 per day matters. Regular contributions plus reinvestment create exponential growth over time. 3. Let compounding work. You cannot skip time. Realistic timeline, fast path, high income discipline to 7 to 12 years, Average path, 12 to 20 years. Slow path, low consistency to 20 plus years. Accelerate it through, avoiding financial leaks like spending emotionally, carrying bad debt, and ignore structure. And use volatility to your advantage. When markets drop, buy more shares, future income increases. If you follow this correctly, something interesting happens. At first, you chase money. Then money starts working. Then one day you realize you're no longer working for income. Your portfolio is. And that's the moment everything changes.